This week, four of the largest technology companies on Earth collectively announced capital expenditure plans totaling approximately $650 billion for 2026. That is not a typo. $650 billion in a single year. To put that number in context, it exceeds the entire GDP of countries like Sweden, Poland, or Argentina. Amazon alone committed $200 billion. Alphabet announced up to $185 billion. These figures are historically unprecedented, not just for the technology sector, but for any industry in any era of modern capitalism. And the market's response was immediate and instructive. Amazon dropped 11% after hours. Alphabet fell sharply. The Nasdaq posted its worst week since April. The S&P 500 slipped into negative territory for the year. But here's what most people are not examining closely enough. At the very same time these corporations are committing to spend $650 billion, the American labor market is deteriorating at a pace that has not been seen in over 15 years. In January 2026, employers announced 108,435 layoffs. That is the highest January figure since 2009, when the economy was still reeling from the worst financial crisis since the Great Depression. Job openings fell to 6.54 million, the lowest since April 2020. The ratio of available jobs to unemployed workers dropped to 0.87 to 1, meaning there are now fewer open positions than there are people looking for work, and corporate insiders, the executives who run these companies, are selling their own shares at the highest rate in 5 years. So we have a very specific situation unfolding. Corporations are spending more money than ever before. Workers are being laid off at crisis-level rates. The people who run these companies are selling their personal holdings. And the stock market, which spent 2 years rising on the promise of artificial intelligence, is beginning to crack. This is not a contradiction. This is a system revealing its internal logic. And understanding that logic is essential if you want to understand where money is flowing, why it is flowing there, and what happens next. That is what this analysis is about. Not panic, not prediction, mechanism. To understand what is happening right now, you need to understand how we arrived at this moment. The story begins in late 2022 when OpenAI released ChatGPT and triggered what can only be described as the largest capital reallocation event in recent financial history. Within months, every major technology company on the planet pivoted its strategy, its messaging, and its investment thesis toward artificial intelligence. NVIDIA, which manufactures the specialized chips required for AI computation, saw its stock price rise by more than 800% between early 2023 and late 2025. The company briefly became the most valuable publicly traded corporation in the world. The so-called Magnificent Seven, NVIDIA, Apple, Microsoft, Amazon, Alphabet, Meta, and Tesla, came to represent nearly 30% of the entire S&P 500 index. This concentration was unusual by any historical standard. What was driving it was a simple but powerful narrative. AI would transform every industry. The companies building AI infrastructure would capture enormous value, and any company that failed to invest aggressively would be left behind. This narrative attracted trillions of dollars in capital, pension funds, sovereign wealth funds, retail investors, algorithmic trading systems, all of them piled into the same trade. Buy technology stocks, buy the AI story, buy the future. And for 2 years, that trade worked. It worked spectacularly. NVIDIA's revenue grew by hundreds of %. Microsoft integrated AI into every product. Meta rebuilt its entire advertising platform around AI models. The earnings justified the investment. The investment justified the stock prices. The stock prices justified more investment. It was a self-reinforcing cycle. And self-reinforcing cycles work beautifully until they encounter a structural limit. That limit is now becoming visible. The structural limit has a specific shape, and it is worth examining carefully. When Amazon announces it will spend $200 billion on AI infrastructure in a single year, what exactly does that money buy? It buys data centers, it buys NVIDIA chips, it buys cooling systems, power generation capacity, fiber optic connections, and real estate. It buys the physical hardware required to run AI models at scale. This is real spending on real assets. It is not financial engineering. It is not stock buybacks. It is concrete and steel and silicon. And that is precisely what makes it significant. Because when a company spends $200 billion on physical infrastructure, it needs to generate returns on that infrastructure. Not eventually, not theoretically. It needs revenue growth that justifies the expenditure within a reasonable time frame. Otherwise, the $200 billion is not an investment, it is a cost. And cost without corresponding revenue destroys shareholder value. This is the fundamental tension that the market began pricing this week. Amazon's cloud business, AWS, is growing. But it is not growing at a rate that justifies $200 billion in annual capital expenditure. Alphabet's AI revenue is increasing, but when you announce $185 billion in spending and your revenue growth rate does not accelerate proportionally, investors start doing arithmetic. And the arithmetic is uncomfortable. The total capital expenditure planned by just 4 companies, Amazon, Alphabet, Microsoft, and Meta, is approximately $650 billion. The combined incremental revenue these companies are expected to generate from AI in 2026 is a fraction of that figure. The gap between spending and revenue is widening, not narrowing. This is the point that most people miss. The AI revolution may be real, the technology may be transformative, but the economics of infrastructure investment operate on their own timeline and their own logic. You can believe that AI will change the world and simultaneously recognize that spending $650 billion in a single year on infrastructure creates a mathematical problem that stock prices must eventually reflect. These two things are not contradictory, they are complementary aspects of the same system. This is generally the overlooked dimension of the current situation. Now let us examine the labor market, because this is where the disconnect becomes most visible and most consequential for ordinary people. The January 2026 employment data tells a very specific story. Challenger, Gray, and Christmas, the outplacement firm that tracks corporate layoff announcements, reported 108,435 job cuts in January. That number was 118% higher than January 2025 and 205% higher than December 2025. It was the highest January total since 2009. At the same time, hiring intentions fell to their lowest level since that same period. The Bureau of Labor Statistics reported that job openings dropped by 386,000 in a single month to 6.54 million. The openings rate fell to 3.9%, the lowest since April 2020. Professional and business services lost 257,000 openings. Retail lost 195,000. Finance and insurance lost 120,000. These are not small numbers. These are structural contractions in the demand for labor across multiple sectors of the economy simultaneously. And here is the critical observation. The companies that are spending the most on AI are among those cutting the most jobs. This is not coincidental, it is causal. When a technology company commits to spending tens of billions on AI infrastructure, that money has to come from somewhere. It comes from headcount reductions. It comes from eliminating positions that AI systems are expected to replace. It comes from reallocating human labor budgets toward machine computation budgets. The COFACE Economic Outlook for 2026 notes that AI investment accounts for roughly 20% of US GDP growth. If you include the wealth effects on consumption through stock market valuations driven by AI company share prices, it accounts for nearly all of it. Think about what that means. Almost the entirety of American economic growth is being generated by a single sector's capital expenditure, not by broad-based consumer spending, not by wage growth, not by productivity improvements distributed across the economy, by 4 or 5 companies writing very large checks for computer hardware. This creates a deeply fragile economic structure. If AI spending slows, if the returns do not materialize quickly enough, if investor sentiment shifts, then the engine driving nearly all US growth sputters, and there is no backup engine warming up. The labor market data reveals something else that deserves attention. The Stanford Institute for Economic Policy Research describes the current employment situation as a low-hire, low-fire labor market. Companies are not aggressively laying off existing workers across the board, but they are not hiring new ones either. Job growth across all major developed market economies has fallen well below pre-pandemic rates, and this creates a slow-motion deterioration that does not show up in headline unemployment numbers but profoundly affects household economics. When a company stops hiring, it does not make the news. There is no announcement. There is no press release. The position simply does not get posted. The recent graduate sends out 100 applications and gets 2 responses. The mid-career professional who lost their job takes 8 months instead of 3 to find a new one. The small business that wanted to expand decides to wait. None of these events individually register as significant, but collectively they represent a fundamental shift in the relationship between capital and labor. Capital is flowing toward machines. Labor is being squeezed out, not through dramatic mass layoffs that generate headlines, but through a gradual structural reallocation that most people feel before they can articulate what is happening. Their cost of living rises, their wage growth stalls, their job feels less secure, they work harder but do not get ahead, and they are told that the economy is growing, that GDP is healthy, that the stock market is near record highs. This is not a contradiction, it is the system operating exactly as designed. Growth concentrated in capital expenditure benefits asset owners. It shows up in GDP, it shows up in stock prices, it does not show up in paychecks. This is the dynamic that most analysis fails to capture. Now consider what corporate insiders are doing with their own money, because this is where the information asymmetry becomes most revealing. In January 2026, corporate insider selling reached its highest level in 5 years. These are the CEOs, CFOs, board members, and senior executives who run the companies that are announcing hundreds of billions in AI spending. They are standing in front of cameras telling investors that AI is the future, that their companies are positioned to dominate, that spending $200 billion is a strategic necessity, and then they are going home and selling their personal shares. This is legal. Insider sales are disclosed publicly. They are often pre-planned through automatic trading programs. There are legitimate reasons for executives to sell stock, diversification, tax planning, personal liquidity needs, but the aggregate pattern matters. When insiders across an entire sector are selling at elevated rates while simultaneously asking shareholders to fund unprecedented capital expenditure, it communicates something about confidence, not public confidence, private confidence. The confidence that shows up not in press releases but in brokerage statements. The informed observer does not listen to what executives say, they watch what executives do, and right now, what executives are doing is transferring risk from their personal balance sheets to the market's balance sheet. The companies are spending, the shareholders are holding, the insiders are selling. This is how wealth transfers work in practice, not through dramatic crashes or obvious fraud, through the gradual legal disclosed process of those with more information positioning differently than those with less information. The stock market reaction this week provides additional clarity on how the system is recalibrating. The S&P 500 fell 1.23% on Thursday alone, closing at 6,798. The Nasdaq dropped 1.59%. The Russell 2000, which tracks smaller companies, fell approximately 2% in a single session, its worst day in nearly 3 months. But beneath the surface, a more significant rotation is occurring. Since the beginning of 2026, the Russell 2000 has actually outperformed the S&P 500. Small caps are up more than 3%, while the broad market is down 0.7% for the year. International equities are performing even better. Emerging markets surged 8.9% in January. Developed international markets gained 6%. Energy and materials led the way as the dollar weakened in the second half of January. What this tells us is that money is moving, not disappearing, moving. Capital that was concentrated in a handful of US mega-cap technology stocks is beginning to redistribute. It is flowing toward international markets, toward value stocks, toward sectors linked to the real economy rather than to AI projections. This does not mean AI is over. It means the trade that concentrated 30% of the S&P 500 in 7 stocks is being repriced, and repricings create winners and losers. The winners are not necessarily who you would expect. The Goldman Sachs 2026 outlook notes that earnings revisions for emerging markets and developed international markets have accelerated and are running well above the S&P 500 on a trailing 6-month basis. The valuation gap between US equities and the rest of the world has widened dramatically since 2020. The price-to-earnings spread used to range between 3 to 5 multiple points. It has expanded to 6 to 10 points. This is not sustainable. Valuation gaps of this magnitude attract mean reversion capital. Smart money sees a US technology sector trading at extreme premiums and international markets trading at historical discounts, and it begins to rebalance. This process has already started, and it is likely to accelerate. Markets are not yet fully pricing this rotation. Now consider the broader macroeconomic context, because the AI spending surge and the labor market deterioration are not occurring in a vacuum. They are occurring against a backdrop of structural economic stress that amplifies both dynamics. The US federal government is running deficits at levels that historically only occur during recessions or wartime, despite unemployment being relatively low. The Congressional Budget Office projects that deficits will remain elevated for the foreseeable future. The national debt exceeds $38 trillion. Interest payments on that debt are now one of the largest line items in the federal budget, exceeding spending on defense. At the same time, tariffs imposed since early 2025 have raised the effective tariff rate on US imports from approximately 2.5% to 16.8%. This represents a meaningful tax on imported goods that is being passed through to consumers. Stanford's analysis suggests that more than 50% of tariff costs are now reaching household budgets through higher prices, so the American consumer is facing a dual squeeze. On one side, wage growth is stalling as companies redirect labor budgets toward AI infrastructure. On the other side, prices are rising due to tariff pass-through, sticky service inflation, and the residual effects of the post-pandemic price level increase. This squeeze is showing up in consumer confidence data, in credit card delinquency rates, and in the composition of consumer spending. People are spending less on discretionary goods and more on necessities. They are relying more on credit and less on income. These are the behavioral signatures of a consumer base that is being slowly exhausted, and the consumer is 68% of US GDP. If the consumer weakens meaningfully, GDP growth weakens. If GDP growth weakens, the AI revenue that is supposed to justify $650 billion in spending becomes even harder to generate. The feedback loop works in both directions. Strength reinforces strength on the way up, Weakness reinforces weakness on the way down. There is another layer to this that connects directly to the financial system's stability. The commercial real estate sector remains under significant stress. Office vacancy rates in major U.S. cities have not recovered from the pandemic-era shift to remote work. Buildings that were 95% occupied in 2019 now sit 40 to 50% empty. This creates cascading problems for regional banks, which hold concentrated exposure to commercial real estate loans. As property values decline, bank balance sheets deteriorate. As bank balance sheets deteriorate, lending standards tighten. As lending tightens, small and medium businesses struggle to access capital. As small businesses struggle, they hire fewer people. As hiring slows, consumer spending softens. As consumer spending softens, commercial properties lose more tenants. The cycle feeds itself, and here is where AI infrastructure spending intersects with this dynamic in an unexpected way. The massive data centers being built by Amazon, Google, Microsoft, and Meta require enormous amounts of electricity. They require physical locations with specific characteristics, access to power, water for cooling, fiber optic connectivity. This is driving a new real estate boom in very specific geographies, while commercial real estate in traditional urban centers continues to decline. Capital is literally flowing from downtown office buildings to suburban and rural data center complexes, from spaces designed for human workers to spaces designed for machine computation. The geography of economic value is shifting, and with it, the geography of employment, of tax revenue, of community investment. Cities that built their economies around being hubs for knowledge workers are losing their economic base. Regions that happen to have cheap electricity and available land are experiencing sudden investment surges. This is not being managed or planned by any central authority. It is being driven by the capital allocation decisions of 4 or 5 companies. The implications for local governments, for school districts, for municipal bond markets, for housing prices in specific regions, these are all downstream effects that will take years to fully manifest. But the cause is happening right now. The Federal Reserve's position in all of this deserves careful examination because monetary policy is the mechanism through which many of these dynamics are transmitted and amplified. Kevin Warsh's nomination as the next Federal Reserve Chair sent a strong signal to markets. Warsh is widely viewed as hawkish, meaning he is likely to prioritize price stability over economic stimulus. His nomination contributed directly to the dollar's sudden strengthening and the precious metals crash in early February. For the AI spending story, the Fed matters enormously. These companies are spending $650 billion, and a significant portion of that spending is financed through debt or is predicated on low cost of capital assumptions. If the Fed under Warsh maintains higher interest rates for longer, the carrying cost of that infrastructure investment increases, the return hurdle rises. Projects that were marginally profitable at 3% interest rates become unprofitable at 5%. This creates a potential trap. Companies have committed to spending plans based on assumptions about the cost of capital. If those assumptions change, the economics of the entire AI build-out shift. Not necessarily in a way that cancels the spending, these companies have the cash flow to fund significant investment, but in a way that changes the risk-reward calculus for investors. A higher rate environment also strengthens the dollar, which has consequences for the international earnings of US technology companies. Roughly 40 to 50% of Magnificent Seven revenue comes from outside the United States. A stronger dollar means that revenue translates into fewer dollars, compressing earnings growth. This is the mechanism through which monetary policy, AI investment, labor markets, and stock prices all become interconnected. Changing one variable ripples through every other variable in the system. The Fed does not operate independently of these dynamics. It is embedded within them. Its decisions shape them, and it is shaped by them in return. The Supreme Court's upcoming decision on Trump's IEEPA tariff authority adds another dimension of uncertainty. On February 20th, the court is expected to rule on whether the president's use of emergency powers to impose sweeping tariffs is constitutionally permissible. If the court strikes down the tariffs, approximately 61% of the tariff revenue collected since 2025, roughly $180 billion on an annualized basis, could be at risk. This would simultaneously reduce government revenue and lower consumer prices, creating a complex set of cross-currents. For the AI story specifically, a tariff reduction would lower the cost of importing semiconductor equipment and components, potentially reducing the cost of the infrastructure build-out, but it would also undermine the strategic rationale for domestic manufacturing initiatives, including the CHIPS Act incentives that have driven significant semiconductor investment in the United States. The point is not to predict the court's decision. The point is to recognize that the economic system in early 2026 contains an unusually high number of binary outcomes, decisions that could go one way or the other with dramatically different consequences. AI spending commitments, Fed leadership transition, Supreme Court tariff ruling, Russia-Ukraine peace negotiations, Venezuela oil production. Each of these represents a branching point where outcomes diverge significantly, and all of them are scheduled to resolve or advance within the next 30 to 90 days. This concentration of decision points is itself a risk factor. Markets can absorb uncertainty about one or two variables. When 5 or 6 major uncertainties are active simultaneously, the potential for correlated surprises increases. The risk is not any single event. The risk is multiple events interacting in ways that amplify each other. So where does the money actually flow from here? The data suggests several patterns that are already in motion and likely to continue. First, the rotation away from concentrated US technology exposure toward broader diversification is underway. This does not require a technology crash. It simply requires investors to recognize that the risk-reward ratio has shifted. When 7 stocks represent 30% of an index and their earnings growth is decelerating while their spending is accelerating, rebalancing is rational, not alarmist. Second, international markets offer a valuation discount that is historically attractive. European equities, emerging market equities, and particularly markets in Asia that are benefiting from supply chain reconfiguration are likely to attract increasing capital flows. Third, the real economy, energy, infrastructure, materials, industrial production is being underweighted relative to the digital economy in most portfolios. The AI build-out itself is a massive driver of demand for real-world resources. Copper, aluminum, rare earth minerals, electricity generation, these are the physical inputs that $650 billion of data center spending actually purchases. The companies that supply these inputs may benefit more from the AI boom than the AI companies themselves, at least on a risk-adjusted basis. Fourth, the labor market trajectory suggests that consumer-dependent sectors will face increasing headwinds. Discretionary retail, restaurants, travel, luxury goods, anything that depends on a confident spending consumer is vulnerable to the slow squeeze being applied to household budgets. Essential goods, healthcare, basic services, these sectors offer relative defensiveness. Fifth, and perhaps most importantly, the structure of the current market creates a premium on flexibility. The number of binary outcomes pending resolution in the next 90 days is unusually high. Investors who are locked into concentrated positions in either direction face elevated risk. Those who maintain the ability to adjust, to respond to new information, to rebalance as clarity emerges, have a structural advantage. Here is the question that actually matters, and it is not the question most people are asking. Most people are asking whether AI is a bubble. That is the wrong question. The right question is this: when $650 billion flows in one direction in a single year, what happens to everything else? Because money is not infinite. Capital allocated to data centers is capital not allocated to housing construction, to small business lending, to infrastructure repair, to worker training, to healthcare research. Every dollar has an opportunity cost. And when the largest companies in the world are making the largest capital allocation decisions in history, the opportunity costs are correspondingly enormous. We are watching, in real time, the largest voluntary reallocation of capital in economic history, not directed by government, not mandated by regulation, decided by 4 or 5 corporate boards in meetings that lasted a few hours. These decisions will shape the American economy for the next decade. They will determine which communities prosper and which decline, which workers thrive and which become obsolete, which industries grow and which contract. The decisions have already been made. The money is already moving. The question is not whether you agree with the direction. The question is whether you understand the flow well enough to position yourself accordingly. Because the system does not wait for understanding. It moves. And right now it is moving very fast in a very specific direction with very specific consequences that will become clear not in years but in months. The data is available, the patterns are visible, the mechanism is operating in the open, the only variable is attention. Are you paying enough of it?